Okay, let's answer some questions from Sunday's video, and some good questions this week. Thank you for these weekly videos. Puzzled by the current scenario, assuming I'm looking at it the correct way. Up until this point, the Fed has followed, to a degree, market pricing in terms of rate expectations. Okay, let's stop right there. We're saying, or at least you're saying, the Fed has followed what the market has been saying. That's a very particular statement. You're saying the Fed is following what the market is saying, as opposed to saying the market was leading the Fed. That the Fed was going to do what the Fed was going to do. It's just that the market got it right. This seems to me that you're implying that the Fed was paying attention to the market and giving the market what it wanted. I don't know that that would be a true statement. I think a more correct statement was the market could clearly see what the Fed had to do. Now, there is a belief that the Fed didn't do enough. The Fed made some mistakes. So if the Fed was doing what the market had expected it to do, and we think that the Fed got it wrong, then so did the market. It just so happened that the Fed got it wrong as the market got it wrong. But I think a better way of saying it is the market leads the Fed. The market has this expectation of what the Fed is going to do, and maybe the Fed does do that, but that does not imply that the Fed was following the market. Markets were basically telling the Fed, well, they weren't telling, markets don't tell the Fed anything. Markets have an expectation of what the Fed is going to do. Markets were basically expecting the Fed to do certain things, telling the Fed they need to stop QE, taper ASAP, and then rate hike. Now that seems to be a divergence where the market is saying there will be a rate cut in 2023 versus what Fed officials are saying. Well, that's because they're all expectations. The expectations may be right. It wasn't difficult in January. It was not difficult at all to say the Fed's got to do something. The Fed has to stop buying assets and start increasing rates, because the Fed was doing nothing. So given doing nothing and doing something, it was easy to say they got to do something. But now the Fed is doing something, and the market is saying, well, you should be doing this something and not this something. Well, that's much harder to predict what they should do at that point. So the market expectations don't always have it right. If the bond market is saying there will be a rate cut in 2023, of which, by the way, this is the percentage of Fed officials that say that that is true. 0. Isn't Powell just following market pricing as generally done? Well, if the bond market is saying there will be a rate cut, and if Powell follows it, you can say that. But Powell hasn't done anything yet. Is he going to start to slow down on the rate hikes? Or is the Eurodollar futures wrong in this case? It depends on your forecast. I'm listening to what Fed officials are saying, and none of them are saying anything anywhere near what Fed futures or Eurodollar futures are pricing in. So it seems to me that it's a lot of wishful thinking. By the way, on the weekend update coming up, I will show you empirically, based on 50 years of previous history, what the probability of this would be, of the Fed actually cutting rates. If we think the Fed is going to cut rates, let's look at base rates. Let's look at, well, did they ever do that in the past? And we'll look at the probability of that actually happening in the time period that the market thinks it's going to happen. And we'll see that by ignoring base rates, we make some common mistakes. So is it a trade opportunity? Personally, I think yes. I think the market has it completely wrong. I'm listening to what the Fed speakers are saying, and they're not saying that. Powell is a train wreck of a human being when it comes to press conferences. He needs to learn how to stick to the script and not speak his mind, because he's just a train wreck. If you want a reason for why financial conditions have loosened since his last speech, it's all on him. It's all on him. Some of the stuff that he said in that press conference, this is all his fault. He's a train wreck of a chairman. So hopefully the rest of the committee is a lot, smarter than he is, and maybe one pulls him aside and says, dude, here's the script. Read from the script. Number 2, nice touch adding the multiple choice questions at the end. Let us gauge how much we're taking away from these. I did that for fun. I threw in 5 questions, for fun, thinking, well, I got some time while everything else is rendering. Let me throw this little thing in there. It just occurred to me. If you like that kind of stuff, yeah, I can put more in. I think it's kind of fun, at the end of the video, have, 5 or 6 questions about what you saw in the video that you can reinforce some of the market data, and you could take that away with you, because we usually forget much of what we just hear if we hear it passively. But, leave some comments in this video if you want more of that. Yeah, that doesn't take me long to do. I can put a little tiny, the week in review quiz at the end of each video. A quick but fundamental question about private real estate investing as a landlord. There seems to be this narrative going around among retail investors that real estate allows you to generate superior risk-adjusted returns versus an equity index fund due to access to leverage that isn't subject to margin calls. Well, I don't know that I would conclude that you'll get superior risk-adjusted returns because of the type of debt that you're using, simply because one type isn't subject to margin calls. I don't know that I would conclude that that was the source of your risk-adjusted returns. But taken as 2 separate statements, can you generate superior risk-adjusted returns in real estate? If you're looking at private real estate, the conclusion seems to be yes, but the question that is raised is, well, is that because private real estate underestimates volatility? Because from month to month, when you value private real estate, it tends to be smooth. Whereas publicly traded real estate does all this kind of stuff. So you have a lot of heightened volatility in public real estate that is absent in private real estate because you don't have market data. The other argument is that no, because this is subject to the whims of the market and a whole bunch of noise, this is actually overstating private real estate, because let's be honest. A building doesn't increase in value by $150 million today and then drop by $75 million tomorrow, then increase by $33 million, then drop by 12. It just doesn't do that, because the cash flows, buildings are worth the present value of all future cash flows, and cash flows don't fluctuate that much. Which camp are you in? Does private real estate understate volatility, or does public real estate overstate volatility? If you believe that the volatility tends to be overstated in the public markets, then compared to a public market that would be subject to the whims of the psychology of the crowd, yeah, you could argue that private real estate does generate superior risk-adjusted returns, but not because of the type of leverage that you're using. Typically, when we look at the return series for private real estate, we look at an unlevered return series, not a levered return series. So if you're looking at the return on equity, that is different than looking at the return on the asset itself. Let's just keep going here. Fixed rate mortgages only require you pay a fixed rate, whereas a leveraged stock portfolio is also susceptible to margin calls if share price drops below a certain level. Ignoring the return element, is the claim about leverage true? Somewhat true. Somewhat. To me, it seems that it is not, because the companies that make up the index are already leveraged, which you're absolutely right. Take ABC, 50% debt, 50% equity. You buy a share. You're buying a share of the equity. You're buying a share of the residual of that particular company. So it is already levered equity. It's levered up by 50%. If you go buy a house with a mortgage, you can lever up to 90%, because you have the value of the house, which again has low volatility. You have the value of the house securing that particular mortgage. REITs that own houses, and there are lots of REITs that own houses, rental houses. REITs that own houses will typically use about 50% leverage. You can use 90% leverage if you own an individual home, but you can also lever up the equity such that rather than having it 50% levered, you can get up to 90% levered by financing 180 shares and you're paying for 100 shares, which would give you a 90% leverage. Your margin call would be lower than if you used 50%. So you can look at the debt equity ratio and you can lever or de-lever the company. Actually, kind of hard to de-lever. You can lever up the company to the whatever leverage ratio that you would feel comfortable with. Let's see, number 4. What I always wondered is, how do you crystallize the narrative of the market? You mentioned throughout the video that the first market thought CPI drops, therefore supportive for equities, but then later the market thought about margins. How do you know this was the overarching thought of the market? Well, I know that they reacted to CPI because I could see the futures and the currencies respond immediately upon the release of the report, and then the market continued to drift in the direction of the initial move. So that is all feeding off of the same report. So that sort of was the theme of the day. Later in the day, it started turning around. But if you listen to Bloomberg, and of all the ones out there, Bloomberg is the best. I don't listen to the talent, the on-air talent, the ones that are on there all the time, the hosts. I don't listen to them. I listen to the guests they have on. And some guests are unimportant to listen to. Some guests are very important. So when they have guests on that are from any of the bigger companies, Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, all of these, they have a voice and they're saying a certain thing. But that thing that they're saying is consistent with what they're saying inside their organization to their clients as well. So they're not going to say to their clients, you should buy this market, and then go on to Bloomberg and say, we are sellers of this market. This is a joke. It is consistent. So when I listen to them and I listen to what they have to say, those concerns must be filtering through the decisions that their desks are making as well. And it was about, from, let's say, about 11 o'clock onwards that the tone started to change, saying we are getting PPI tomorrow. These prices have dropped, but all we know is that prices have dropped. But that is going to compress margins unless costs have dropped as well. We're a little bit cautious before we commit money. We'd like to see the PPI just to see what's it. So that theme sort of got a hold as well. Not to mention that you already had a big enough rally that there was some profit taking ahead of that. That's really the best you can do. You don't really know 100% why a market is moving the way it moves. All you can do is say, well, look, here's the big themes of the day. These themes have to affect people because they're the big themes. Now, there could be a whole bunch of little operational stuff going on that, well, it just so happened that this happened at that time. That's why you saw a dip of 5 or 10 points on the futures, that you try to attribute some meaning to it, but sometimes there is no meaning to the move. But for big, broad themes, when everybody's talking about the same thing, that's really, you can really suggest that is the overriding blanket narrative that's going on. Okay, next question is actually a very good question, and it is a puzzle. I'm really concerned. The market has put the Fed into a very tough position. If the Fed raises only 50 basis points in September, that can send the wrong signal to the market. The market continue to rally and financial conditions will continue to loosen, which is exactly the opposite of what the Fed is trying to do. I agree with that. The market is saying, oh, they're off of 75 basis points for September. They're going to go with 50 because the data is improving. Then they'll go 25, 25 and stop. So if you say, here's the path that they're going to go down. They're going to go down this pathway over here. But on this pathway, you've got some unrealistic things down here. Well, for this to become probable, the Fed just has to step on the path. The first path is 50, 25, 25, minus 25, minus 25, minus 25. And this is the pathway. Well, this is the real pathway, right? You have all of these branching that goes on before you even get to this point. But if they do 50, the market will say, aha, you see, next is 20. They're on that path, and it's almost as if internally in their minds, there's only one path, and you're on that path. Yes, that is, and I think the Fed is aware of that if they go 50, they actually may have even harder work to do. So they may take next week's opportunity at Jackson Hole to really, really beat the market up with the narrative. To say, if you think that we're going to stop at 3.5 and start cutting next year, you are out of your mind. And they have to say it. If they're going to go 50, they're going to have to bark really, really loud before the meeting. Otherwise, they're going to have to go 75 to make their point. Let's see, if the Fed raises 75 to make the point, it can narrow the soft landing path. That is fantasy to begin with, and send the economy into a recession as monetary policy starts to take effect. On the weekly outlook I do this week, I'm going to show you, we'll do a grid like this. This is growth above trend, and this is growth below trend. This is inflation above trend. This is inflation below trend. We are over here right now. And we're going to look at the last 50 years, and we're going to look at quarter over quarter. How realistic is it that if you're in one of these quadrants to move to another quadrant in one quarter? We're in this quadrant. How realistic is it to move from this quadrant to this quadrant in one quarter? So that we have one quarter that we observe here. The very next quarter, which seems to be what the market is saying right now, we're going to be in a different quadrant. We're going to look at the base rates and see what's the probability of that happening. And once we look at the probability, you'll realize that this is off the table anyways. Send the economy into recession as monetary policy starts to take effect. Well, as of right now, inflation is the enemy. And it is not month-to-month inflation. They're going to be looking at a 3-month moving average of inflation and probably a 3-month trimmed moving average. And they're going to want to see that trending down for an extended period of time. That's about a year. Until it gets to, and if they say until it gets to the target, then they're not going to move for about 2 years. They're going to keep rates elevated for at least 2 years. So if they're going to break the economy to fix inflation, may as well break it now. I mean, you may as well break it now. Nobody likes a slow bleed. You may as well just get it out of the way. I think Powell shouldn't say what he said last meeting. No, I think we all agree on that. What he says has created a false expectation for the market and made their job even tougher. I agree on that as well. In fact, if I were a lawyer, I would say we have the grounds for a good class action lawsuit against Powell based on injurious reliance. He said things that we then relied on to our injury. Hey, look at that, some legal speak there. What scenario would you rather see? I'd rather see 75. In fact, I'd rather see 100 because you have to fix this narrative. What do we have going on? You have credit spreads that are shrinking. You have mortgage rates that are dropping. You have equity prices that are rising. You have bond yields, capital market bond yields that are fairly subdued. You have the meme stocks that are back. Look at Bed Bath & Beyond. What's the hope there? What is the hope there other than just to play? It's just, we got all this money, we got nothing else to do. Let's do this stuff all over again. Let's get back to this. You got Bitcoin going up. You got all the excesses coming back in the market, which the Fed absolutely does not need at this point because inflation is the enemy and all of this is working against them. If you look at some of the costs that have come down, some of them have turned around. Energy is good. Energy keeps coming down, but there are releases from the SPR, and we haven't hit the fall yet. The release from the SPR ends, I think, in less than 60 days or 60 days. That's done. And if Russian oil is completely off the global markets, that's over. If you can't get the Iranian oil on the market, which is the last drop on oil was because there's a potential breakthrough with Iran for getting oil on the market. If you can't get that on the market, all of that reverses. So I'd rather see a larger move because you've got to get inflation under control. Very, very simple reason why. The longer inflation goes on, the more negative it is for real GDP, which means if we want to get back to the party, We want inflation to be done as soon and as fast as we possibly can. Dripping out the rate hikes and letting the market think that that we're going to start cutting rates is only going to make it longer and longer, which means you'll have underperforming GDP, under trend for years, and that's a tough market to be in. A really tough market because it's a sideways to a downward market under those conditions. I want a bull market, and to get a bull market, you can't declare this bear market over yet. If you try to declare this bear market over, you'll have a slow drift downwards quarter after quarter after quarter as the Fed has to continually raise rates higher and higher and higher. And every time they raise, the market thinks, okay, this is the last one and it'll get better. Now let's look forward. And the market moves to to loosen what the Fed has just created. In fact, I would say that for this rally, you've pretty much undone that 75 basis point move that happened. That's pretty much undone. Other than in money market rates, it's pretty much undone. So basically that last meeting was zero. Now keep in mind in September as well, the balance sheet runoff doubles. Not that it's running off very quickly right now, but it does double. Quick question, what are the benchmark bonds for the OAS calculation? They're not benchmark bonds, they're benchmark credit ratings. So if you Google BBB OAS FRED, you will get a credit spread for the category of BBB. Within the BBB are a whole bunch of bonds that make up that category, but this would be the spread for the credit rating as opposed to using any one particular bond as the benchmark bond. It is the rating, because within that rating there could be a whole bunch of bonds, but a bond that's rated BB will, if it's in that category, will pretty much have the same spread as other companies that are rated BB as well. Pretty much have the same, not the exact same, but pretty much they'll be in that neighborhood. Next one, what sort of time frame on the 210 are we talking about for high probability hit on recession? There is no rule. It is the combination of two D's, depth plus duration, and it is really just the deeper the inversion and the longer the inversion, the higher the probability of recession. So we are inverted, I think, today by 45 basis points versus 41 on Sunday. So we are at a deeper level. So you could say the probability of recession just increased. And since we're Wednesday, and Wednesday is 3 days longer than, the last inversion that we measured was Friday, since we're 5 days longer than Friday and 4 basis points deeper, both signal higher probability of recession. So it's really just depth and duration, but there's no cutoff that, if you hit this level for this long, it is guaranteed. Just to put things in perspective, in 2000, it was inverted a maximum of 47 basis points for almost 10 months. We are at, I think, 45 today, and we're somewhere around a month and a half into our inversion. Before the 2008-2009 hit, it was inverted, I think, a maximum of 16 basis points, and I think it was over a period of 2 to 3 months. However, that was a very exogenous event that happened. I mean, a lot of people saw that there were excesses in the system, but it wasn't the interest rate hikes that brought it down. It was a default from inside the system. Somebody inside the system playing the game failed, and that caused, I think if you can remember, Lehman, was it Bear Stearns or Lehman Brothers? I think it was Lehman. That was the first moment. And then we kind of looked past that and realized that, no, that is a big deal. So depth and duration. I'm wondering, what is your suggestion for retail investors to invest in the government bond market? Given that government bond ETFs are also very liquid and volatile, retail investor can hardly get access to directly own a 10 or 20-year government bond and hold them to maturity. Oh, no, you can if you're using Interactive Brokers. You can access the liquid part of the government bond market. So you can buy government bonds right through Interactive Brokers, both in the US and in Canada. Typically, you would have to go through a broker. If you're on another trading platform where you can trade options and stocks, you probably aren't even going to have access to the bond market. That's what's nice about Interactive Brokers. It's any security you want in any market, anywhere in the world, you can get it. You want to buy Japanese government bonds, you can buy them. You can get them through Interactive Brokers. So just use IB. What statement about, would that statement about the slope hold true with the yield curve in Europe, or are different markets entirely different to look at the same indicators across market? Yes, that would hold true in any market. Okay, the GSCPI, the Global Supply Channel Pressure Index, is now at February 21 level. Freight rates are coming down sharply. How much of this could explain the recent nice CPI and PPI prints? I think a bit of it, yeah, and therefore could see nice follow-ups in the flexible components, yeah. So here's the thing about price displacements. Let's say that we're going along nicely and then we have some kind of disruption where prices start to go crazy for a while. If you can get them back here quickly, they don't get into the system. They may disrupt some pricing in some channel somewhere, but they don't get into the system. But the longer you let it go, it gets into wages. Once it gets into wages, it is now in the system. That is a different type of inflation. So even if this disappears, you have now imported it into another component in the economy that is not flexible. So you've taken flexible inflation. It didn't repair itself quickly enough. Over time, it found its way into wages because it went on for too long. Companies realized that they had to raise their prices because this wasn't just going to go away. It wasn't just going to be a one-quarter hit to margins. It was going to be continual, so I better raise my prices, which everyone did. And then employees said, well, with all of these prices going up, there's inflation. I need higher wages. That brought the flexible part into the sticky part. Now it's a problem. The time to fix it was way back here, and to get it out of the flexible component before it found its way into the sticky component. But now it's in the sticky component because wages is an input to absolutely everything. So now it has to get out of the system, because what you need to do is you have to get employees back to asking for a wage increase because they're just better at their job. Right now they're asking for wage increases because prices are going up. That is the price-wage spiral. Prices are going up, you got to pay me more. And that's got to disappear so that the employee then starts saying, I've been here a year longer, I'm better at my job, I'm more productive, I'm worth more. But employees now are simply worth more simply due to the passage of time because prices are increasing. That is bad. You got to get that out. The Fed is not going to look at July in isolation, and they're not even going to look really at the CPI. They don't really care about the CPI. They're going to look at the PCE. And they're not going to look at one PCE. They're going to look at a 3-month moving average, and they're going to look at the 3-month moving average of the trimmed mean to determine that inflation is out of the system. So inflation does this. Month to month, you get this kind of stuff. By looking at the trimmed mean, it'll take this kind of volatility off, and it'll determine, is it going this way or is it going this way? Because you can have this kind of thing going on, right? And notice that you have an upward movement if you take away the volatile components on each end. The ones that went really up, the prices that went really down, you trim those and you look at what's left in the middle, the mean. That tells us how much inflation is embedded in the system overall. Now, you can have something that looks like this, inflation doing this kind of thing. But once you take away the components, you might have a trimmed mean that is like 1.1%, and the 3-month moving average for the last 6 months has been 1.1%. Well, then inflation really isn't a problem. There's something over here. Something's going on that's making something volatile, but it's all volatile. It's all flexible. Well, good. You don't really need the interest rate to work on that, because the interest rate doesn't really do a lot on the flexible component. For example, interest rates aren't going to do anything to fix food pricing. Only the ships of grain leaving Ukraine recently have done something to lower wheat prices. That's what fixes it. So you have interest rates changing while you have a bunch of vested interests trying to fix the supply channel. The danger is thinking that the interest rate fixed the supply channel. No, it didn't. two things can be true at the same time. Interest rates went up, but there were a whole bunch of vested interests trying to fix a supply channel. Those vested interests would have been trying to fix a supply channel in the absence of interest rate increases. So what the interest rate really tries to work on is this trimmed mean and the 3-month moving average, which is why one data point creating a super big rally and the idea of a Fed pivot is pure fantasy, because if you look at the 3-month moving average of the trimmed mean, even in CPI, it's going up. PCE going up. That's the trimmed mean. So it is super fantasy to think that, oh, it's going to pivot. No, it's not. All right, let's see if I can erase some of this messiness over here that I put in so that we can talk about what's going on down here. Bit confused. 10-year real yield is 0.35. 10-year nominal is 2.79 with PCE at 6.8. When you're talking about real rates, you're going to use CPI. You're going to use the price level if you're looking at levels in interest rates. If you're looking at retail sales and you want to bring that down to a real measure, then you would use PCE. PCE is the cost of living, not the price level. You want to adjust your bond rates for the price level, not the cost of living. Wouldn't real rates be negative? Yes, if there was a single 10-year rate along with a single 10-year inflation expectation, yes, but that's not how it works. So have a look over here. Let's put inflation expectations at 8%. Here's 2% where we got to get to 1 year, 2 year, 3 years, 4 years. And let's say it takes a little bit of time, but we're going to get to 2% somewhere on year 3 forward. The present value of a bond is all the payments and discounted along with in 10 years. Let's say this is the 10 year. In 10 years, the future value and the payment discounted. Well, this coupon will be discounted at 1 plus R being a real rate plus some inflation expectation. This coupon will be discounted a little bit lower, a little bit lower, a little bit lower, and then all of these will be discounted 2% with the future value and the last payment way out here. But most of the weight is on the principal amount that you get back in the future. So when we see 2.79, it means that over these 10 years, inflation looks like this, where these coupons will be discounted at higher rates, and then you get to lower rates. So what we're saying when we look at the break-even rate is we're saying the average level of inflation over those 10 years would be 2.79 minus 0.35. That is the inflation expectation built into the average over 10 years, not the rate today. So if we were taking, let's say, the 1-year treasury, 1-year US, well, we'll just call it a T-bill because it's not treasury. Take the 1-year rate. I think that's around 3%. And the last reading on CPI showed 8.6%, because you got to take the full CPI. You got to take the headline number. Well, you wouldn't use the 8.6% because this rate here is for a 1-year investment, starting today and ending in 1 year. This 8.6 was the change in the price level from here to here. So to figure out what a real rate on the 1 year is, you have to figure out, well, what is inflation going to be over this year? What is the expectation? We'll take this minus the expectation to get our real rate. So if you think, well, inflation will be 0%, well, then you have a 3% real rate. If you think, well, inflation is going to drop, how would you figure out what it would be? A couple of ways you could do it. You could take the month over month change in the CPI, and you can annualize it. So it'd be 1 plus whatever the change is. I'll just put delta CPI, whatever the change in the index. Actually, I wouldn't put index because it's not the change in the index, it's the change in the inflation rate. 1 plus the change to the power of 12 minus 1 will give you an annualized inflation rate for the year going forward. But that's not very helpful at all. Because it only considers 1 month. What we'd like is a trend. So we'll take the 3-month average inflation rate, the 3-month, month over month average inflation rate, and put that to the power 4 minus 1 for an inflation expectation here and subtract it from the 3. And that is how we would get what the real rate on the 1 year is. Taking a 1 year rate, which I see the market do a lot. Let me get rid of some of this stuff down here so I have some room to write. I see the market doing this a lot, saying, well, the 1 year rate is 3%. Inflation is 8.5%. You have a negative real rate of 5.5. Draw a timeline. This 3% is if you took an investment today and you held it for 1 year, you would make 3%. It is over this period of time. This 8.5 is, here's the price level here, here's the price level now. We're up 8.5% year over year. These are two different time periods. What did we learn in level 1, time value of money? If you're moving money around on a timeline, you have to get all the money at the same point in time to compare dollars. You can't compare dollars at different points in the timeline. This is technically super, super lazy. What you would do is have some forecast for what you think it would be in here, and the best forecast is the 3-month moving average of the month-over-month changes. So 1 plus the change in inflation using a 3-month moving average, and you'll annualize it. If it's a quarter, you put it to the power 4 minus 1, and there would be your inflation expectation in there.